In the world of Forex trading, understanding the different types of orders is crucial for effective trading strategies. An order is essentially an instruction you send through your broker's platform to open or close a transaction when specific conditions are met. This article will break down the various types of Forex orders, ensuring you know which ones your broker accepts and how to use them to your advantage. Forex orders can be categorized into two main types: market orders, which are executed immediately at the best available price, and pending orders, which are set to be executed at a specified price at a later time. Let's delve deeper into each category to understand their functionalities better. A market order is an instruction to buy or sell a currency pair at the current market price. For instance, if the bid price for EUR/USD is 1.2140 and the ask price is 1.2142, placing a market order to buy would execute at 1.2142. Key features of market orders include instant execution, as they are executed immediately at the current market price, and price uncertainty, as the final price may vary from the expected price due to market fluctuations. A limit order is a type of pending order that allows you to buy below the current market price or sell above it. A buy limit order executes at or below a specified price, while a sell limit order executes at or above a specified price. For example, if EUR/USD is trading at 1.2050 and you want to go short at 1.2070, you can set a sell limit order at that price. If the market reaches 1.2070, your order will be executed automatically. The advantages of limit orders include favorable prices, ensuring you buy or sell at a price that is more advantageous than the current market price. Stop entry orders are activated when the market price reaches a specified stop price. A buy stop order triggers a buy when the price rises to the stop price, while a sell stop order triggers a sell when the price falls to the stop price. For instance, if GBP/USD is at 150.50 and you believe it will continue to rise after hitting 150.60, you can place a buy stop order at that price. A stop loss order is designed to limit your losses on a trade. It closes your position automatically when the market price reaches a specified level. For long positions, you use a sell stop order to limit losses, and for short positions, you use a buy stop order. For example, if you bought EUR/USD at 1.2230 and set a stop loss at 1.2200, your position will close automatically if the price drops to 1.22200, limiting your loss to 30 pips. A trailing stop order is a dynamic stop loss that moves with the market price, locking in profits as the price moves favorably. For instance, if you short USD/JPY at 90.80 with a trailing stop of 20 pips, your stop would move down to 90.60 if the price drops to 90.60, locking in a 20 pip profit. Time and force orders specify how long an order remains active before it is canceled. Common TF orders include good for the day, which is active until the end of the trading day; good till canceled, which remains active until filled or manually canceled; immediate or cancel, which must be filled immediately with any unfilled portion canceled; fill or kill, which requires the entire order to be filled immediately or it is canceled; and good till date, which is active until a specified date. Conditional orders like OCO and OTO link two orders together based on specific conditions. OCO means if one order is executed, the other is canceled, which is useful for managing risk and exiting trades. OTO means the execution of one order triggers the placement of another, ideal for setting stop loss and take profit levels before entering a trade.